we're going to take a really close look at the U.S. financial market using a recent analysis.
Yeah, trying to figure out what's actually happening now and maybe where things are headed.
Exactly. And it's a strange picture, isn't it? The sources we're looking at describe this mix of underlying tension, but also these surprising pockets of, well, optimism.
That's right. You see the big indices like the S&P 500, they're holding up pretty well. Tech is strong.
But then you've got inflation still, hanging around. There's trade uncertainty, recession questions.
It's a lot to unpack. So our mission today is really to dive into that mix using this analysis. We want to pull out the key insights, the surprising bits, the forces really driving things.
And help you, the listener, understand what the source material suggests is going on, and crucially, what it might mean for your money.
Okay, do it.
So let's start with that mood, the market sentiment. What's the feel right now, according to this analysis? Has it changed much lately?
It definitely has. The report really points to a shift in the last few weeks, moving away from, let's say, a more fearful stance towards cautious optimism. It's not like everyone's wildly bullish, but less negative overall.
Cautious optimism. Yeah, that sounds about right for the moment. And the analysis mentions a specific data point related to this. Goldman Sachs and recession odds.
Yes, exactly. They've apparently nudged down their 12-month U.S. recession probability forecast. It was 35%, now down to 30%.
Okay, so a small tweak, but significant.
Well, the source suggests it signals maybe a bit more confidence, still tentative, mind you, but growing confidence that perhaps the absolute worst-case scenario isn't quite as likely right now.
What else is fueling that cautious optimism? What positive signs does the analysis point to?
There are a few things mentioned. The Chime Financial IPO debut on the NASDAQ, that got attention.
A fintech company.
Yeah, it had a really strong first day, surged over 59%. That's seen as a sign that investors might be getting interested in growth again.
Okay, a successful IPO after things being so quiet on that front? Yeah, that feels like something.
It does. Plus, you've had some decent earnings reports coming out from major banks, some key tech firms, too. That helps.
And inflation, you mentioned that.
Right. And importantly, the analysis points to signs that, those inflationary pressures are continuing to cool off, especially in areas like energy and some consumer goods.
So some concrete good news, but you stressed cautious optimism, and the source does too. What's keeping things fragile? What are the worries?
Well, first off, the Fed. They're still pretty guarded, making it clear they're not, rushing into rate cuts.
Okay.
Then there's trade. Tensions with the EU seem to actually be heating up, which adds this layer of global uncertainty.
Right.
And consumer debt. Even though consumers have been resilient, that overall debt level keeps climbing. That's a potential weak spot down the road. So, yeah, definitely a mixed bag, but positives are getting a bit more focus for now.
You mentioned inflation cooling. It's been the dominant story for, gosh, how long now? Where does this analysis say things stand right now, as of June 2025?
It's definitely cooled off from those really high peaks in 2022, early 2023. But no, it's not gone. And crucially, it's still above where the Fed wants it to be.
What are the numbers looking like?
Core inflation, that's stripping out food and energy. It's sort of hovering around 3.1%.
It's like over 3%.
Yeah. And the report also notes wage growth is still pretty strong in certain sectors, like healthcare and tech specifically, and housing costs, things like rent. Well, they're not climbing as fast as they were, but they're still historically high. So that component of inflation is, sticky.
So good news, it's not accelerating wildly. Bad news, that 3.1% core is still quite a ways from the Fed's 2% target.
Exactly, which is why the analysis suggests interest rates might have to stay higher for, longer than maybe some people are hoping.
Which brings us right to interest rates. The big question, isn't it? Is the Fed just pausing, or are they getting ready to pivot and actually cut rates?
Well, they have paused the hikes for now. The main rate, the federal funds rate, is sitting around 5.25%. But, yeah, the analysis really emphasizes this split among investors about what comes next.
You got the optimists.
Right. They're looking for rate cuts maybe by late 2025. Hoping that gives stocks a boost, makes borrowing cheaper again.
And the other side, the skeptics.
They look at that sticky inflation, that 3.1% core number we just talked about, and they warn, hold on. They think any cuts could easily get pushed way out, maybe into 2026 even.
This feels like one of those areas that directly hits home for listeners. What does the analysis say about what higher rates mean for, your everyday finances?
It's pretty straightforward. You're likely paying more interest on credit cards, definitely on new mortgages or refinancing, auto loans too.
But there's a flip side for savers.
Yes. If you've got money in savings accounts or CDs, certificates of deposit, you're finally earning a better return after years of, well, practically nothing.
It really underlines how Fed decisions ripple right down to individual pockets. Okay, let's switch gears slightly. Another area waking up, according to the source, the IPO market. We mentioned Chime.
Yes, after a real dry spell, that Chime debut is definitely highlighted as a significant moment.
Why the focus on just one IPO, though? What's the broader implication?
It's seen as a potential signal.
Yeah.
A sign that investor appetite might be coming back, especially for those growth-focused tech companies. Maybe a willingness to take on a bit more risk again for future potential.
And a healthy IPO market matters for the whole economy, doesn't it? The analysis touches on that.
It does. Generally, a busy IPO market reflects confidence in longer-term growth. It brings new companies, innovation, competition, and maybe especially relevant now, it could help diversify the market a bit. Right now, so much is concentrated in just a few huge tech names like Apple, Microsoft, NVIDIA. New IPOs can broaden that out.
But a word of warning for people thinking about jumping into new IPOs?
Oh, absolutely. The report is very clear. Not every IPO is a winner. Personal investors really need to do their homework, look at the company fundamentals, not just get caught up in the first day excitement.
Good advice. Okay, let's look outwards. Global stuff, trade wars, tariffs, always simmering. The U.S.-China situation seems maybe calmer, but the source points somewhere else.
Yeah, the spotlight, according to this analysis, has really shifted towards the European Union.
Okay. What are the friction points there? What are the U.S. and EU disagreeing on?
The report lists quite a few things. Agricultural exports, how drugs are priced, digital taxes are a big one, and those long-running disputes over aircraft subsidies.
Yeah.
The Boeing versus Airbus thing.
So how does that kind of uncertainty, these potential trade spats, how does that actually affect the market or maybe our investments here?
Well, it can hit specific sectors pretty hard. Think about big industrial companies, multinationals with major supply chains or sales in Europe.
Right.
And the analysis also mentions currency effects. It could potentially strengthen the euro against the dollar. If that happens, American exports become more expensive for Europeans, and that can dent profits for U.S. companies selling over there.
It's a reminder of how interconnected everything is. Global politics impacting domestic markets. Okay, let's turn to the banks. The source describes the big U.S. banks as quietly recovering.
Yeah, that's the phrase used. The analysis cites some analysts who apparently see banks like Goldman Sachs, J.P. Morgan Chase, Bank of America, entering what they call a buy zone.
A buy zone. Sounds positive. What does that actually mean in practical terms?
Well, technically, it suggests their stock prices are hitting certain levels on the charts that analysts see as signals of potential long-term strength.
Okay.
Plus, the banks themselves are reportedly buying back more of their own shares, which tends to boost shareholder value. And crucially, their profit margins seem to be stabilizing because loan defaults, while they exist, haven't spiked dramatically. They seem manageable.
So, for someone building a balanced portfolio, the source seems to suggest it might be a moment to maybe reconsider financial stocks, especially the solid ones with good balance sheets and dividends.
It's presented as potentially an interesting area, yeah, especially after all the volatility that sector saw not too long ago.
Let's talk about the U.S. consumer, kind of the engine of the economy, right? The analysis says they've been surprisingly resilient despite everything.
That resilience has been key, absolutely. It's really propped things up. But the report is pretty clear that underneath that surface, some cracks are definitely starting to show.
Cracks. Okay, what specifically? What are the warning signs the analysis points to?
Well, the big one is credit card debt. The report flat out says it's at an all-time high.
Wait, all-time high? Seriously, with all the talk about strong consumers, that feels like a major disconnect?
It really does. And connected to that, delinquency rates, people falling behind on payments, are apparently rising, particularly among younger adults who maybe have less of a financial buffer. The analysis also mentions the whole buy now, pay later boom services like Affirm, Klarna.
Yeah, they're everywhere.
Right. And the source frames that not just as convenient, but potentially as another sign of financial stress, people needing to spread out payments, even for smaller things.
And are retailers seeing this? Does it show up in where people are spending?
Exactly.
Right.
The report notes that generally luxury brands seem to be holding up okay, but the more budget-focused stores, think Walmart or Dollar General, they're seeing growth slow down or even dip in some categories, which suggests the pressure is really mounting on those middle and lower income families.
That makes sense. Gives you a real picture of who's feeling the pinch. Okay, let's shift to real estate. The source calls the housing market a strange spot, or in limbo.
Yeah, limbo feels right. It's not crashing, but it's not exactly booming either. It's just stuck.
What's keeping it stuck? What are the specifics from the analysis?
Well, mortgage rates are still the big one. They're lingering up near 7%, and that just prices a lot of potential buyers out of the market. But at the same time, home prices, well, they stopped soaring like they were, but they haven't really fallen much either, nationally speaking.
And not enough houses for sale.
Exactly. Inventory is still really tight, especially for homes that are, more affordable.
So you have high borrowing costs, high prices, and not much to choose from. What's the expert view cited in the analysis say? Just wait it out if you're a buyer.
Pretty much. Patience seems to be the key word. There's a forecast mention that maybe a more significant price correction, if it comes, might not happen until late 2025 or possibly even into 2026. The idea is that these higher rates need more time to really cool demand enough to maybe boost inventory or ease prices.
Okay, so we've covered a lot of ground sentiment: inflation, rates, IPOs, trade, banks, consumers, real estate. Let's try to pull it together. What does the source say is the outlook for the stock market itself over the next, say, 6 to 12 months? They lay out two main paths, right?
They do. First, there's the bullish case, the scenario where the market keeps climbing.
What would need to happen for that positive outcome?
Basically, this scenario depends on the Fed actually starting to cut rates by late 2025. It also needs inflation to keep heading down towards that 2% target, and for companies to keep posting strong profits.
And if all that lines up, which parts of the market lead the way?
Tech and financials are tipped to lead, according to this view, with industrials probably doing well too. And the potential gain for the S&P 500 in this bullish scenario. The report suggests somewhere in the range of plus 8% to plus 12%.
Okay, decent upside potential there, but what about the flip side? The bearish case, where the market drops. What could trigger that?
Well, this negative path gets triggered if inflation stays stubbornly high, forcing the Fed to delay those rate cuts maybe well into 2026.
Okay.
Or it could be driven by trade wars really sheeting up with the EU. Or if consumer spending suddenly drops off because of all that debt we talked about. Or maybe a weakening housing market starts to really hurt bank profits.
A few potential triggers there. And what kind of drop are we talking about for the S&P 500 in that scenario?
The source estimates a potential decline of between negative 10% and negative 15%.
Wow, okay. So a pretty wide range of potential outcomes depending on which way these key factors break. Now, the crucial part. Let's make this really practical. What does all this mean for you, the listener, managing your own money? The source pulls out some key takeaways.
Yeah, these are really the practical bits of advice drawn from the analysis, aimed at helping navigate this kind of environment.
Number 1, diversify. Sounds basic, but still crucial.
Absolutely. Don't put all your eggs in one basket. The source stresses mixing it up, different types of stocks like tech, growth, value, maybe use ETFs, those exchange-traded funds that hold lots of investments, and even consider some shorter-term bonds right now.
Okay. Second point, have an emergency fund.
Super important, especially with consumer debt so high. The report really hammers this. Aim for 3 to 6 months of essential living costs, easily accessible, like in a savings account.
Got it. Third, keep a close eye on interest rates.
Yeah, they're not just abstract Fed numbers. They directly affect your borrowing costs, what you earn on savings.
Yeah.
Their direction matters for a lot of your financial decisions.
Fourth, don't try to time the market.
Classic advice, but maybe even more relevant now. The analysis warns against trying to jump in and out based on guesswork. Instead, the focus should be on consistent contributions over time, sticking to your long-term goals, rating out the bumps.
And the last one, review your risk tolerance. This feels important right now.
It really is. The source suggests you actually think about it.
Yeah.
How would you honestly feel, and what would you do if the market drops significantly, like that potential 10 or 15%?
Yeah.
Does that thought make you want to panic sell everything? If so, your current mix of investments might be riskier than you're truly comfortable with. You need to make sure your portfolio aligns with how much fluctuation you can actually handle without making bad emotional decisions.
That's a great point. Okay, let's wrap this up. How would you summarize this current phase for the U.S. financial markets based on everything in this analysis?
Transitional seems to be the key word used. Inflation is cooling, yes, but it's not quite tamed. The Fed is cautious, holding steady for now. And those global dynamics are shifting with the focus moving towards Europe on the trade front.
And for the average investor trying to make sense of it all, the core message from the sources, just focus on the fundamentals.
Pretty much. Looking ahead for the rest of 2025, the source forecasts that stocks will probably stay volatile. There's potential for gains, maybe in tech, banking,
Yeah,
energy, but
big bet.
a lot of that hinges on whether those rate cuts actually materialize by the end of the year, say Q4.
What about bonds?
They could become more appealing if the Fed does start cutting rates. Lower rates generally make existing bonds with higher yields more valuable.
And real estate.
Expected to kind of stagnate, especially in those expensive city markets where affordability is really stretched thin by rates and prices,
Gonna consumers.
likely to keep shifting their spending, prioritizing necessities, maybe experiences, perhaps pulling back a bit on non-essential luxury goods as budgets feel squeezed for some.
The source leaves us with a final thought that I think is really powerful. It says, look, the road ahead is definitely uncertain, no doubt about it, but it's not hopeless.
Right. In fact, it makes the point that these kinds of complex, messy, transitional markets, they're often where disciplined investors actually build serious long-term wealth.
It's not about trying to predict every twist and turn, hitting home runs.
No, not at all. It's about being prepared, staying disciplined with your plan, and really playing the long game.
So the final takeaway from this deep dive really boils down to that preparedness. If you're new to investing, the advice is start small, but be consistent.
Keep learning, understand what you actually own, and focus on those long-term goals, not the daily headlines or market noise.
It's about building that wealth slowly, steadily, and smartly, no matter what the market throws at you next.